Silver has long been sought after as a precious metal, and its price often follows gold's lead. But like all assets, its price depends on supply and demand factors. Assuming all other factors remain equal, if supply of a good increases, its price will fall, whereas if demand increases, its price will rise. So let's start with supply. There's a far bigger supply of silver than gold, which is one of the reasons why silver costs a lot less. But the supply of silver is still limited because it's most often extracted from the ore of other metals rather than being mined directly. So any change in the supply of these metals could affect silver pricing. But what about demand? Unlike gold, silver has lots of industrial uses. It's used in photographic film, solar panels, LED lights and batteries. So industry accounts for over 50% of total demand for silver. If these industrial demands rise or fall, there'll be knock-on effects for silver's pricing. Geopolitical and financial uncertainty can also affect demand. Just like gold, silver is seen as a crisis commodity, a safe haven asset that people buy when market or global tensions rise. In such times, silver often outperforms other investments. For example, high inflation can drive investors to silver. When consumer prices rise, the price of silver tends to rise with them, making it a valuable hedge against weakening currencies. And silver may also perform well in times of deflation. This is when consumer prices fall, business activity slows, and the economy struggles with debt. The value of the US dollar is an important factor as well. When the dollar falls against other major currencies, people often buy silver. Assuming other factors remain constant, this increase in demand will drive up silver prices. When the dollar is strong, however, silver's luster diminishes, so its price is likely to drop. For these reasons, silver's price can be much more volatile than gold's, creating many opportunities for traders to profit by speculating on movements in price. A key measure for investors is the gold-silver ratio, which records how many ounces of silver you can buy for the same price as an ounce of gold. There have been huge fluctuations in this ratio, from around 20 in 1970 to just below 100 in 1991. Over the last few years, it's tended to hover between 40 and 80, so some investors see a ratio of 80 or higher as a good opportunity to increase their silver holdings. With an IG trading account, you can open a position on silver whether you expect it to rise or fall in value. The profit or loss you make will depend on the extent to which you get your prediction right. To start trading, open an account. To learn more about trading, join IG Academy.